Mortgage rules relaxed to increase lending, record number of landlords selling up, corporate landlords investing more and more in the build-to-rent sector, and a new tax that could hit nearly every home worth over £500,000. If you own property, rent property, or are dreaming of getting onto the ladder, what's been happening over 2025 is something you can't ignore, because UK property hasn't just shifted, it's changed forever. And if you don't know me, I'm Gale, and I've spent the last 13 years building national property businesses, British home buyers and British home sellers, a nationwide estate agency. And between them, we've been involved in over 14,000 transactions worth more than £5+ billion of property. And I can tell you firsthand, I can tell you straight, I've never seen so many moving parts in the housing market change at the same time. So let me break it down clearly. The 5 biggest forces that are reshaping UK property in 2025. Change 1, mortgage affordability rules boost buyers. Now, here's something important that most of the mainstream press didn't really ever cover, but it directly affects who can and can't buy a house in 2025. The FCA, the Financial Conduct Authority, updated lenders in March on how they should apply what's called the mortgage stress test rule. Let me explain this simply. Since the financial crash in 2008, banks have had to stress test every mortgage. That means they don't just check if you can afford today's mortgage rates, they test whether you can still afford it if interest rates jumped much higher. For example, if your mortgage was 5% today, the bank might test if you could still pay it at 7 or 8%. That was meant to protect borrowers and the system from another financial crisis. But here's the problem. Interest rates are now falling in 2025, yet many lenders are still using really harsh assumptions like testing against the reversion rates, the rates you roll onto after your fixed deal ends, plus an extra margin on top. So in practice, this means a lot of buyers are being rejected even though they could easily afford the mortgage at today's interest rates. So what has the FCA done? They've basically told lenders, you have more flexibility than you think. Don't automatically use sky-high reversion rates. Base your tests on realistic market expectations for the next 5 years. If rates are trending down, your tests should reflect that. They also reminded banks that under the new consumer duty rules, they have to offer fair value. In plain English, don't design your mortgages in a way that unfairly locks people out. So why does this all matter? Because it's a quiet loosening of mortgage lending rules. It's not as dramatic as scrapping stress tests entirely, but it's a signal from regulators that they want more people to be approved for mortgages. And that means more transactions, more demand, and potentially more upwards pressure on house prices. And just when you thought that was it, the FCA went a little further. In July 2025, they released this big update, sort of mortgage rule review. Now, that sounds very dry and technical, but here's what it actually means for you and me. They've simplified the mortgage rules. They've removed a lot of old red tape, and they're actively trying to make it easier for people to switch lenders, cut costs, and get approved. So what are the key changes? First, remortgaging just got easier. If you're stuck on a high rate with your current lender, these new rules are meant to make it smoother to switch across to a new one. Second, you can reduce your borrowing term more easily. That means paying off your mortgage faster, saving on interest without as much paperwork holding you back. And thirdly, you've got more freedom to discuss options with lenders. Before, the rules meant lenders had to give full advice every time you wanted to talk about your mortgage. Now you can just explore choices more informally without triggering all that regulatory baggage. In simple terms, the FCA is loosening the system. They're saying to lenders, be flexible, innovate, and make it easier for consumers to move around and save money. And they've been very clear. This is just the first step in a much bigger review of the whole mortgage rulebook, the whole system. So why are they doing this? Because the government and the regulators want growth. They want people moving, borrowing, and buying homes. And by relaxing rules like stress tests, remortgaging restrictions, and affordability checks, they're trying to grease the wheels of the housing market. Bear in mind, on top of this, the loan-to-income flow rate, flow limit change has come in. So from July 2025, only lenders issuing over £150 million annually are bound by the rule limiting high LTI loans, so 4 times your income, to 15% of their new mortgages. So smaller lenders are exempt, broadening access to high income multiples for borrowers. We're starting to see more like 5-6 times your average income. And of course, on top of this, from July, the government's new mortgage guarantee scheme was available to lenders. But here's, I think, the biggest question about all of this. Is this about helping people, or is this about keeping house prices propped up, keeping the economy propped up? Because when you make it easier to borrow, you don't just increase affordability, you increase demand, and with supply still so constrained, that demand risks pushing prices right back up again. Change 2, supply surging, growth slowing. Rightmove and Zoopla are both reporting the highest number of homes on the market in over a decade. Listings are up 10% year on year, which sounds great, but demand is up only 4%, which means sellers are chasing buyers, not the other way around. Zoopla's forecast, they think house price growth will slow to 1.5% to 2% for this year. That's effectively flat when you adjust for inflation. So the problem is clear. A flood of sellers coming off cheap 2% mortgage deals from back in 2020, 2021. Many are facing payments jumping 30% or more right now. Some simply can't afford to refinance because of that, so they're selling instead. I'm seeing it all the time with my agency. It's a huge wave that's hitting the market, and it's only just started. It's starting to make sense why the FCA and government are so keen to make it easier to borrow more and more money, because what happens to the market if they don't? Change 3, the buy-to-let exodus. So the introduction of the Renters' Rights Bill, all the uncertainty around tax for landlords is driving landlords out of the market. We all know that, which I know on one hand seems great. Less demand from landlords means less competition in the housing market. But it's a double-edged sword. Short term, you get a drop in supply for rentals, which increases rental prices, which we're seeing. Longer term, corporate landlords are stepping in to capitalise, which I'll get into later because that's not really a great thing. The government commissioned this report, the English Private Landlord Survey, which was published in December just gone. It's a government-commissioned evidence-gathering survey of private landlords in England. So this report is designed to be neutral, statistical, and descriptive. And this report, funded by the government, found that large landlords with 5 or more properties are twice as likely to have evicted a tenant in the past 12 months. Large landlords are significantly more likely to raise rent between tenancies or during renewals. So 75% of large landlords increased rent for new tenancies, for instance. 63% of them increased rent on renewals, for instance. Small landlords are far more likely to hold rent steady, especially for long-term tenants. So it found small landlords are often more lenient or emotionally invested in their tenants, whereas larger landlords adjust rent based on the market. They aren't as emotionally invested in the tenant. The tenant is just a number. So this is the thing. According to the government's own English Private Landlord Survey, landlords with just 1 property or 2 property were most likely to be planning to sell, and the top reason they gave were all this increased regulation, reduced tax relief, and uncertainty around reforms like the Renters' Rights Bill. And who's staying behind? The big boys. The corporates, the ones with 5, 10, 50, 100, thousands of properties, the ones more likely to evict, to push up rents, to treat tenants like numbers on a spreadsheet. So it's a double-edged sword. While the goal should be about protecting renters, what policy is actually doing is pushing out the statistically better landlords and leaving behind the ones we're statistically more likely to like least. This bill will widen wealth inequality in the UK because it's the small landlords that are leaving. It's the same pattern we've seen across other industries. The local coffee shop getting buried by the big corporate like Starbucks, the family-run fish and chip place replaced by a soulless corporate fast food chain, the black cab driver pushed out because of Uber's algorithm. Why? Not because the big players are necessarily always better, but because they can handle the red tape at scale, absorb the costs, and scale their business through those systems. And what do we end up losing as a society? We lose the personal service, flexibility, local trust. That's exactly what's happening in the rental market right now. It will grow wealth inequality and not solve the problem in the housing market. It's corporates, institutions and larger portfolio landlords piling in. And so the next section should be no surprise to you. Change 4, the rise of the corporate landlords. Today, we're no longer just competing with day-to-day landlords. We're competing with BlackRock, Lloyds Bank, Granger UK, Legal in general. They own thousands of homes, not a few, not a dozen, thousands upon thousands of them. They're buying entire developments before they hit the market, entire streets. BlackRock is even buying into brick manufacturers, literally controlling the building blocks of the UK housing market, the supply chain to UK housing. That's how much they're backing it. Blackstone is even buying up railway arches. Why? Because housing is a safe investment. Inflation makes rents go up. Debt stays fixed. People always need a place to live. Housing, sadly, has become too profitable to leave to the people, to us. People who rent have to pay rent if they can't buy, even when everything else collapses around them. Because as you've probably seen before from this Maslow hierarchies of needs diagram, food, water, shelter are our core needs and something the massive corporate landlord knows. Let's talk about the final major change. Change 5, the tax time bomb. The biggest wild card of 2025 is taxes. HMRC already raised almost £15 billion from stamp duty last year, despite a slowdown. But think tanks are pushing for new land value tax to replace council tax and stamp duty. Leaked proposals suggest a new levy on homes over £500,000 could be something that comes into play. And if that happens, the impact on middle-class homeowners, particularly in the southeast, could be seismic. I mean, you get 2-bed flats for £500,000 in London. So, in conclusion, here's where we are. Mortgages are easier to get, but risks inflating prices again. Supply is up, but mostly because people are being forced to sell. Landlords are leaving, but corporates are circling in. And taxes could flip the whole market upside down. That's why I say the UK property market has changed forever over 2025. The question is, to all of this, do you think these changes will stabilise the market or push it into something unrecognisable? Drop your thoughts in the comments. I learn a lot from your comments. I read and reply to almost all of them. And if you want clear data-driven updates like this every week, subscribe, hit the bell notification, and importantly, share this video with someone who needs to understand this, because the more of us that understand the problems in the housing market, the more likely it is we can push for change. Because what happens next affects all of us. If you liked this video, I highly recommend you watch this one up here. Bye.